welcome to the show.
All right.
You always remind me of Matthew McConaughey.
Matthew McConaughey.
When he does that. All right,
Is that
all right.
I'll take that.
Yeah.
I'll take getting compared to Matthew McConaughey. He's got a few more hairs on his head than I do.
I'd love to have his hairdo.
Yeah.
I think it was put on anyway. So.
You know what? I want to start this podcast with 2 quotes.
Ooh, okay.
Okay.
You do. It's your floor, man.
Here's the first one. Attributed to our friend Vladimir Lenin. Okay.
Our friend. I never met the guy.
There are decades when nothing happens, and there are weeks where decades happen.
Wow.
If that isn't a quote for the last couple of weeks, I don't know what is.
That's very true.
Right? I mean, I talked about it a little bit on the email or the newsletter this weekend. It's unbelievable the amount of turmoil that's going on.
Oh, it's chaos. I mean, yeah, it's wild. It's a wild ride. It's not going to calm down anytime soon.
No. The second one, I just lost it on my thing. The second one is an old Chinese curse, right? May you live in interesting times. And when they say interesting, it's derogatory, right?
Right.
It's kind of unbelievable what's happening. And I think how it relates to us and TSP, the S fund gaps up a couple days before the assassination attempt, right? And everybody looks at it like, oh, the market's up because of the way Trump responded to the assassination attempt, right? That's not what happened, right? But that's a big part of the narrative. Then on Wednesday that week, a couple days later, which was the top of the most recent top, right? The news, I'm going to say, gets leaked that Biden is going to step down that weekend, and the market rolls over. And then, so there's all the talk about the Trump trade's over, and now the uncertainty's back because nobody knows, if you are managing your TSP based on the news, you've got to be out of your mind.
Yeah, you're going crazy right now. I mean, we know that a lot of people do.
Yeah.
And you have to manage it by what the market's doing, not by what the TV's telling you it's doing or why it's doing it. And it's just a lot of stress, that you don't need.
Events affect the market, at least in the short run. They absolutely do. But in the big scheme of things, you have no possible way of knowing why things happened, and based on that, what's going to happen next, even more importantly.
That's right? More importantly, yeah. Right? Yeah, not using that information to say, oh, well then, if this happens, if this person does this, gets in here and does that, that's no way to manage your retirement account or anything.
Unfortunately, it's like human nature.
Yeah.
But
the media, I don't want to say the media like bad thing, but like, television and social media and all, it's done it to us.
Yeah.
I mean, back in the days when you got your stock market prices from a newspaper when it came out in the morning, was probably about the least chaos I can remember.
Yeah.
I remember, sitting in my grandparents' living room, my grandfather getting the paper, coming in, going right to the financial section, opening it up. Oh, let's see how such and such stock is doing. And I look back at that and go, wow.
It's nostalgic.
That must have been nice.
Yeah.
You know what I mean? Like that. Yeah. I honestly think it would be nice. All you would know is the closing price.
Yeah.
Because that's all you really need to know. You're not day trading.
Right.
People that are need to know it, but, you don't need to have 24/7, coverage.
In finance or anything else. I mean, it's insane.
All right. What do you got for us?
Here we go. We're going to go through it kind of quick, but we got a lot of things. Some of them I've already done. So credit spreads, that's the smart money. The 2-year yield versus the S&P 500. So we all know that the Fed's going to start cutting rates, right? The next rate cutting cycle is going to happen. Most people think September. There's an outlying chance of July, except we got some news this morning that unemployment, well, not unemployment, but new claims ticked up a little bit, but they're attributing that to Hurricane Beryl in Houston. And there was another piece of news, I cannot remember what it was, but it basically now it seems like bad news is starting to become bad news, which is kind of a good thing because we've been in reverse land for a long time. But we'll take a look at the 2-year yield and what actually happens with the S&P 500. The NASDAQ QQQs versus XLP, which is consumer staples. So when people want things, they buy the NASDAQ. When they need things or they're being defensive, they buy the XLP. So we'll take a look at that ratio. It's pretty telling. VIX versus the S&P, what's happening there. Yield curve versus the F fund. F fund is really important. We talk about that a lot in the newsletter this weekend. XLK is the tech sector. We'll do a quick look at that and the TSP fund charts. So credit spreads. Credit spreads are the smart money, right? The credit market is, when there's fear in the credit market, it's real, right? It's not. This is a weekly chart. Credit spreads are in black. S&P 500 is in orange. When credit spreads start to spike, there is a problem in the economy, and the market's about to tank. It's a real problem. It's not like a little spike up or spike down, or the normal volatility that we get. They're real problems. And when credit spreads are falling, the market's doing great. Okay, so if we just go back to here was the bottom in 2003. Credit spreads hit a peak and then started falling. Right, as soon as credit spreads start falling, the market starts going back up. Credit spreads spike right before the top in 2008. Okay, a big spike, right? Because we had lower highs, lower lows going into this bottom, and once we got above this high on credit spreads, that was a problem, and it kept going up, and the market eventually rolled over. Credit spreads come down, right? After the bottom of 2009, everything's great. We got the 2016 was a pretty interesting time, had credit spreads spike there. So all that to say, where we are right now, credit spreads just put in a new low. Okay? We should see, if the market is really going to turn over, we should see credit spreads start to spike. And it doesn't happen immediately. The big money knows it's coming. So credit spreads tend to lead the actual collapses in the market. I'm not talking about, we could have a regular summer correction, 10 or 15% or whatever. I'm talking about big, 2008, 2000 style corrections. We're not seeing that yet in credit spreads. And that's really the smartest money in the room. So it's not a timing tool as far as, I want to catch the top of the market or whatever, but it does not look yet like the market is rolling over for a major collapse in terms of credit spreads. 2-year yield and the S&P 500. So when the Fed lowers rates, it affects everything from the 2-year yield to less time, to the notes, the 3-month, 1 month, 6 month, 1 year, and 2-year notes. So the 10-year and the longer ones are more, the bond market has control of that, but the Fed has control of the short term. So you got a top in 2-year yield back in 2000. Once the Fed starts cutting rates come down, the market goes down, right? Because the Fed is either lowering rates to kind of cool off the economy, or because the economy is tanking. And usually the Fed keeps rates too high for too long. And so when the rate cutting cycle initially starts, it seems like it's going to be a good thing for stocks, because it's always the I call it the Goldilocks scenario. Is that what they call it? The idea that there's not going to be a recession, but inevitably the Fed starts cutting rates faster to put a floor under stocks. So you got the rate hiking cycle here going into 2006. Fed keeps rates stable and then starts lowering them before the rollover in 2008. Okay, but once the Fed starts really lowering rates, the market comes down. It was the same thing here in 2019. Actually, we had a high in rates. The Fed starts lowering rates well before COVID started, right? Once COVID started, then they just dropped them to zero. But it was already, so it's not like you were anticipating COVID by noticing that the Fed is lowering rates as the market is still going higher. But something's going to happen, almost definitely. It just turned out to be COVID in this case. And so now, the Fed just got off the steepest rate hiking cycle in history. Okay. And we've been flat now. The Fed's held rates higher for longer for a long time. And it looks like as soon as we break this trend line to the downside in rates, the market is very likely to tank. We're not there yet. The rate cut cycle probably starts in September. And if it's a quarter point and then a half point, you'll know they're chasing the market down. And so it's going to be really interesting to see what happens in the fall in terms of interest rates and how the market responds. But it does not mean that the market has to tank, on September or whatever, 3rd or 4th, whatever that first rate cut happens. Okay, risk on, risk off. So when people buy the NASDAQ, the QQQ, they're high growth stocks, right? They're the Magnificent Seven and all that. Everybody has a lot of confidence in the economy. Market's going higher. Everything's great. XLP is consumer staples. They buy those things. It's a defensive sector. It's one of the most defensive sectors. So the ratio of XLP, of QQQ to XLP, when that ratio is the candlesticks and the S&P 500 is orange. So when people when the market's doing well, right? Stock market's going up. The NASDAQ versus the XLP defensives is going up, right? More people are buying the NASDAQ than they are buying defensives. Once that changes, right, people start getting nervous about the economy in here. They're buying more defensive stocks than they are NASDAQ, even though the price of the S&P is still going up. But eventually they both roll over, right? The top one rolling over means way more people are buying defensive stocks here than they are the NASDAQ, right? And that's why goes along with the S&P falling. And it's usually when it's a major top, kind of like credit spreads, it doesn't happen at the same time. You get smart money getting out, getting defensive long before the market actually peaks. You get the same thing going into the top in 2022, right? People are getting really defensive here, even as the price is still going higher. We don't have that right now, right? You get the ratio and the S&P 500 falling at the same time. And so what I'm taking away from that, at least initially, is this probably isn't going into a major top. It's kind of like what we had in April, right? You got the ratio and the market rolling over at the same time. There's not enough time in here for smart money to get out if we're at a major top. Okay, so again, I'm not saying we couldn't have a pretty decent correction in the summer. I just don't think the market collapses like this from where we are right now. The VIX and the S&P 500. So the VIX is the fear index, right? The VIX is in black, S&P is in orange. When the VIX spikes, and it's kind of a coincidental index, so it's not great to use day to day. But if you look at the trend of it, the VIX is putting in higher highs, right, and higher lows back here. So the trend of the VIX is moving higher, even as the S&P 500 is still moving higher and topping. Okay, so it's really, my opinion is it's better to look at the trend of the VIX and not what happens on a given day. So ever since the bottom in October, right, we had a high in the VIX there, but then we had a lower high, right, and we get lower lows, lower highs, lower lows. So the VIX, the trend of the VIX is coming down as the S&P 500 is moving higher, right? Then we had a spike into the summer correction last year, right? So here's the summer correction, but it was still below this high, right? And so the trend of the VIX is still down. And where we are right now, it's been a tough week for tech, but we still have a lower high in the VIX. Now, if we come down and put in a higher low, right, and the VIX moves up from there, yeah, there's a good chance that we're going to put in a higher high and things are coming down. But for right now, the trend of the VIX is still down, right? The overall trend of the VIX is still down, which means the overall market should keep going higher. All right, yield curve and the F fund. So this is the 10-year yield minus the 2-year yield, right? So this is what they call the inverted yield curve. So you've probably heard in financial media, every time the yield curve goes inverted, we get a recession. It's not really when it goes inverted, it's when it uninverts. So it gets below that zero line. When it comes back up through it, that's when we have problems. So that was the 1990 recession right there. This was 2001. This is 2008. COVID just barely hit that line, right? That was 2020. Where we are right now is the longest inverted period, I think, ever. Certainly going back to the 1980s, but I'm pretty sure this is the longest inverted period ever, which means there's a lot of power. So potentially we have a really bad recession, right? That's one way of looking at it. The orange line is the F fund. AGG only goes back to 2003, so that's where it starts. But when the yield curve is falling, the price of the F fund is going down. When the yield curve is going up, the price of the F fund is going up. Okay? So where we are right now, the yield curve is getting ready to cross back above that zero line. When that happens, we're expecting a recession. The F fund goes up when the yield curve goes up. The F fund is almost a no-brainer at this point. I'll say almost, because there are scenarios where the yield curve can reverse and the F fund will continue down with it. But it certainly looks like we got a 1, 2, and we're beginning at 3, 4, 5 in the yield curve. And if that happens, the F fund goes higher. Okay, tech. So XLK it's not all the Magnificent Seven, but they're certainly all in there. And it's been driving the market since the bottom in October 22. It's the only sector in the S&P 500 that's outperformed the S&P as a whole over that time. And where we are right now is basically right at that 20-week moving average line. 20-week hasn't been a great moving average line for support, right, all the way along here. Sometimes these moving average lines work really well for some indexes or sectors, and sometimes they don't work so well. So this one might have been a 50-week moving average line, might have been better supports for this. But it looks like XLK can come down a little lower, hit this trend line, and then keep moving higher, right, if that's going to happen. So it still looks like in the short term there's some room for tech to go lower. So we'll have to see, but it'll be really interesting to see what happens if and when tech gets to this trend line. If it breaks this trend line, the market goes much lower because tech, even though the other sectors can kind of compensate for it, tech is 36% of the S&P 500 on its own. So definitely a good one to watch. But in the short term, tech can definitely move a little lower. Okay, TSP fund charts. So last week we threw up this chart of the C fund. It's a weekly chart of the C fund, 20-week moving average line. The black circles are every time we get a bearish engulfing candle. So when this red candle absorbs the whole price of the prior week's green candle. Okay, that's a bearish engulfing candle. And we don't always get that pattern at tops, right? We didn't get it here. That wasn't a bearish engulfing candle because it didn't engulf all the price there. But when we do get it, it's always some kind of significant top. Okay, so that's why we pointed that out last week. So this week, and full disclosure, this is going through the close on Wednesday. We have an event that we're going to this weekend, so we're doing the show a little bit early.
We will be on motorcycles for the next 4 days.
We will.
So we will be watching the market, but we won't be able to do a podcast. So that's why I'm already in my motorcycle gear because my motorcycle's outside, and we're taking off as soon as we finish this.
Yep. So
wish us well.
Yeah, hopefully you'll see us next weekend. So where we are right here, this bottom, it's not the close on Friday. It's close on Wednesday. So you got 2 trading days left. There are some things that can happen for sure, but this week, if you watched the show last weekend, this week should not have been a surprise. Every time we get that bearish engulfing candle, and that was a big one last week, you're looking for the market to come down. You're still pretty well above that 20-week moving average line. So the next support level, certainly, we got support back here in April. That's the next support level. So if you're following this on a weekly basis and you're making your decisions based around that 20-week moving average line, you still got a little ways to go before you're looking at a decision. Okay. S-Fund, we got a huge breakout a couple weeks ago. It looked like we were getting a great follow-through, right? That was until Wednesday 2 weeks ago. And then the market completely rolled over, gave us that bearish doji, it's called, when the market opens and closes basically at the same place, but it's got a huge move up and then a huge move all the way back down. That's bearish. It's not great. It's not a complete failure yet of that breakout, but it's pretty close. So we'll see what happens by the end of this week, which is right here. iFund, nothing's changed for quite a while. You got a triple top in 2021. You got it's at the 82 level. We tried to hit it 4 weeks back earlier this year. Then we tried to hit it again a couple of weeks ago, and it keeps getting rejected. But on the positive side, it keeps getting rejected to higher lows. Okay, so it's forming this bullish triangle. It just needs to break above 82, and then it's off to the races. But it doesn't have to do that. It could easily come back to 82 again and roll over, right? The triangle could fail. So until it proves it and gets above that 82 level, iFund's not a great place to be. And the F fund, we're going to talk about it quite a bit in the newsletter, but it's sort of a no-brainer. The pattern is great. Looks like a left shoulder, a head, a right shoulder. It just needs to break above this neckline, and the F fund should move higher. You get the Fed lowering rates. The F fund should definitely move higher, but it hasn't done it yet. So if I have my crystal ball on, I'm saying, yeah, the F fund's going to move higher. My technical analyst hat, responding to price and not when I think should happen, says the F fund hasn't confirmed yet that it's going to move higher, and there is an alternate count. It's possible that this is all a big consolidation off of this move down, and we go lower from here. It seems very unlikely because if the F fund goes lower from here, it means rates are going up, not down. But
anything could happen.
It's all in the realm of possibility.
Yeah, and it's been very tempting not to jump into the F fund just to kind of get ahead of it, right?
Yeah.
And if you have a low risk tolerance, maybe that's something you want to do. Put part of your allocation into the F fund, and hope you catch it, right? But we're not there yet, at least on that chart.
Yep, absolutely. Right, a lot of stuff in there. Some of it we had done before, but I think the big takeaway is we are in the midst of this summer correction.
Yeah. To
the extent that we're going to get it, it's very likely that it goes all the way through the election. But at this point, the big money isn't bailing.
Mm-hmm. Not everybody's jumping off.
No.
All right, guys, if you like what you see, please share it with your friends. Catch us here every Sunday, 6:30 p.m., and we're going to go hop on a motorcycle.
All right, let's do it.
Take care. Be safe.